Carol, let's get to start. Good afternoon, ladies and gentlemen. This is Brad Penny. I'm the Director of Government Relations at the Alliance to Save Energy in Washington, D.C. Welcome to this afternoon's webinar, Financing Energy Efficiency, with our featured presenters, Congressman Steve Israel from New York and Matthew Brown. This is going to be a very interesting webinar for the next 90 minutes devoted to talking about creative financing mechanisms to promote energy efficiency. Financing energy efficiency improvements, particularly in retrofits, has been a major barrier. And Congressman Steve Israel, who has his own PropertyAssessed clean energy bonds legislation in the House, has kindly taken the time from his busy schedule this afternoon. And we're going to be going to the Congressman very shortly because we understand he may have some votes coming up around 1:30. But first I'd like to ask my colleague Carol to say a few words about the very important webinar instructions for those of you who are joining us, particularly anybody who may have difficulty accessing the audio.
Just a couple of comments for our attendees, hopefully, and surely everyone who can hear me now has had no problem with the audio element. So we'll skip right down to the question and answer section. At any point during the webinar, if you'd like to ask a question, you'll see at the top you have a Q&A menu. It's the fourth one over from the left. So if you click on the Q&A menu, there's a box there where you can ask your question, and that your answer will appear for all as soon as it's answered. If you do have several questions, it doesn't let you go back and modify it. It doesn't let you go and ask multiple questions. So just be sure to go back and modify your original question, and we'll be sure to address them. We're going to do first a question and answer if we have time with Israel in the beginning, and then we'll do another question and answer with Matthew Brown later on. And in addition, if you look in the upper right-hand corner of your screen, there's an area there. There are three pieces of paper filed on top of each other, and it says handouts. Matthew Brown and Congressman Israel have uploaded several of their own documents, which you should be able to download if you have interest in accessing those handouts.
Great, Carol. Thank you very much. And just want to point out that the audience will be muted during the presentations. Next, I'm very pleased to turn to Julia Levin, who will introduce Congressman Israel. Julia is a current commissioner for the California Energy Commission, having been appointed to this position by Governor Schwarzenegger this past February. Before joining the CEC, she was the director of Audubon's global warming campaign throughout the country. She previously worked for the Union of Concerned Scientists, the U.S. Agency for International Development, the World Bank, the National Heritage Institute, and Trustees for Alaska. So she has a very broad background in environmental issues. Julia received her BA from Brown University in 1985 and her law degree from the University of California, Hastings College of Law. Julia, thank you for making time this morning, Pacific time, to introduce the Congressman.
It's my pleasure, and if I may, before I introduce the Congressman, I'd like to say thank you to the Alliance for organizing this call. The California Energy Commission has been a long-time supporter and fan and very grateful for the work of the Alliance, and I think this call is typical of the timely and informative work that you do. So thank you for continuing your leadership on that. I also just want to make a quick plug from California for how excited we are that other states, and now with Congressman Israel's leadership, are following in our path on these property-assessed clean energy bonds. I think that we pioneered this idea first in the city of Berkeley and then in the state of California with state legislation 2 years ago, and I'm thrilled now, and congratulations to Congressman Israel, that the state of New York adopted similar legislation just yesterday. And we know that Congressman Israel is going to lead Congress to pass legislation that can be used to help the states in this area. So it's very exciting. There is enormous interest in the states in this field. I would say in California we've put about $100 million of our state energy program stimulus money into this these sorts of programs, and we've had a couple of $1 billion of interest worth of proposals. So the interest is enormous, and the time is right for this very, very important area. So with that, I would like to introduce Congressman Israel, who is the honorary vice chair of the Alliance to Save Energy. In addition to that, minor detail, he also happens to be the representative from New York's 2nd Congressional District, which he has served since 2001. Congressman Israel is on the House Appropriations Committee, where he serves on the Water and Energy Subcommittee, which happens to be responsible for Department of Energy, the Army Corps of Engineers, and other agencies, as well as a subcommittee on military construction and I think various other subcommittees. He is an expert on energy security and clean technology, the new green economy. I would say he's an expert and leader in these areas. He helped to pass the Cash for Congress program. He helped to resist and restore budget cuts under the previous administration to the Department of Energy's Energy Efficiency and Renewable Energy program. He helped to restore funding for hydrogen fuel cells and a variety of other clean energy and energy security issues. Currently, Congressman Israel is leading the way not just on PACE funding and authorization, but the Solar Villages Initiative and energy security on U.S. bases and energy security in the U.S. military. So with that, I'd like to hand it over to Congressman Israel and thank him for his incredible leadership in these areas.
Julia, thank you so much for a very flattering introduction, and thanks also to Brad Penny and Matt Brown. Carol, thanks so much. And let me give a particularly strong tribute to the Alliance to Save Energy. I really rely on them as the intellectual firepower for all issues pertaining to energy efficiency and how we can catalyze markets and find ways of creating new avenues of financing to address the most glaring vulnerability in our national security, which is our dependence on our adversaries to sell us the fuel to fuel our weapon systems to protect us from our adversaries. I am on the Appropriations Subcommittee on Energy and Water, and I spend about 75% of my time in Congress on energy issues. Occasionally, my time on energy issues is interrupted by things like votes, and that's going to happen in the next 10 minutes. Unfortunately, the Democratic cloakroom just told us that we should expect votes at about 1:15. I'll have a little more time beyond that, but I think I can only stay on for about 10, 12 minutes before I have to rush to the floor of the House and cast some votes, and then thankfully be able to go home and spend some time with my constituents. We're talking about property-assessed clean energy bonds, and let me just give you a little bit of background. I told you that I spend 75% of my time on energy, grappling with critical energy issues, and I've come to the conclusion that for all of the talk about our need to reduce our dependence on foreign energy supplies, for all the good national security arguments, for all the good economic arguments, for all the good environmental arguments, we're really not going to make a dent in this until we can find ways to ensure that companies and individuals are getting a return on investment. That is, that until we can make this economically viable for most people and get around the initial hurdle of front-end investments, we're going to talk about these issues for another 30 years without really making an appreciable impact in it. And we think we found a way to do just that, to create some creative financing mechanisms that would enable people to do energy efficiency retrofits, to deploy renewable technologies, alternative technologies, and do it in a way that makes it financially feasible for them. And these are called PACE bonds. Just a little bit of background. We all know that energy efficiency is probably the fastest, most effective, most quantifiable way of reducing our dependence on foreign oil and foreign sources of energy. Commercial and residential buildings are responsible for 40% of all greenhouse gas emissions annually in the U.S. Nationally, about 75% of our commercial buildings are more than 20 years old. That's the target. That's where the greatest need for energy efficiency is. If we were to find ways to retrofit that aging building stock, we could drastically reduce the carbon impact. And we calculate that there's about $400 billion in economic opportunity on those energy efficiencies. Everybody talks about a jobs bill, and everybody talks about a highway bill, and everybody talks about infrastructure. There's $400 billion in economic activity and job growth just waiting for us if we can find ways to make it more financially feasible and profitable to do those kinds of energy retrofits. And that's what PACE bonds are all about. Forgive me as I flip through these quickly, but I am sensitive to the fact that we're going to have to leave fairly quickly for votes. Three missing words in U.S. energy policy: return on investment. That is the bottom line is the bottom line. And until we can figure out how companies and how individuals can capture that return on investment for energy efficiency retrofits, we're not going to make lots of progress. That's where PACE bonds come in. PACE bonds are property-assessed clean energy bonds, and they incentivize private property owners with a more desirable return on the investment. 15 states across the country have authorized PACE bonds, and I'm very happy to report that at my urging, the state of New York, just within the past couple of days, has passed a PACE bond authorization, and the governor is expected to sign that fairly soon. Here's how PACE bonds work. They can be issued by municipal financing districts or finance companies. Let me give you a typical idea, a typical example. Mrs. D'Amico, who I represent in Deer Park, New York, or Donald Trump, who I would love to represent in New York City, but don't. They both want to do the right thing. They want to insulate their windows. They want to weatherize their properties. They may want to put a solar panel on their roofs, but they're not able to do it because of that exorbitant front-end investment. A PACE bond would allow the city of New York or the town of Babylon in my congressional district to finance those improvements. They just go into the bond markets. They borrow money. PACE bonds proceeds would be lent to Mrs. D'Amico or be lent to Donald Trump to finance energy retrofits. Those are efficiency measures or small renewable energy systems. The repayment of the loan to the municipality is about 20 years via an annual assessment on the owner's property tax bill. So they go out, Mrs. D'Amico goes to the town of Babylon. She says, I want to swap out all of my old inefficient windows for double insulated windows. The town of Babylon would finance that for her, and the town of Babylon would impose a small additional assessment on Mrs. D'Amico's property tax bill, but Mrs. D'Amico immediately experiences the benefits of a major reduction in her utility bill. Probably about 17% instantly. And this borrowing, another attractive aspect of this borrowing, is that Mrs. D'Amico doesn't want to go out and borrow money for solar panels on the roof and have to pay that out of her own pocket if she's going to sell her house in the next several years. This lien is attached not to the personal owner of the house, but to the property itself. And so there's no disincentive to finance these kinds of efficiencies. So municipalities now have new tools to spur private sector investment and to improve energy efficiency. It's immediate job creation. If Mrs. D'Amico or Donald Trump goes into the markets to buy new windows, to buy small renewable systems, to retrofit with energy efficiency technologies, that creates a quick infusion of jobs, attracts new clean energy companies to the area. The obligation is the liability of the real estate owner, and you get all of the ancillary benefits. And of course, in terms of in an era where nobody is excited about increasing taxes or talking about increasing taxes, this is an opt-in. If Donald Trump doesn't want a slight marginal increase in his property tax assessment, then he's not going to opt into this, and the same for Mrs. D'Amico in Babylon. We know that PACE bonds will dramatically improve the economics of energy retrofits because of this financing, 20-year repayment. And by the way, since the repayment is done through property taxes are fully deductible in the federal tax code. So essentially the federal government is helping to subsidize the deployment of energy efficiency technologies and renewable technologies. And so the bottom line result is a much higher, much faster return on investment. Here's why this is so critical. The Department of Energy understands the argument that we're not going to make much progress on energy efficiency and renewable energies unless we can tackle this return on investment problem. And so just several weeks ago, the department announced over $450 million in Recovery Act funding for PACE pilot projects nationwide. They want to develop the best practices for PACE. Applications are due to the Department of Energy on December 14th, and municipalities are eligible for up to $75 million in Recovery Act funding for these demonstration projects around the country. This was announced by the Vice President and Secretary Chu. give you a quick status of where PACE bonds are, and then they just called votes, but I'll have about 6-7 minutes to answer questions after I just give you a quick summary. The PACE bonds and the demonstration funding is important, but what I believe really changes the game is to use the existing loan guarantee authority that the Department of Energy has to guarantee these bondings. Why is that important? Number one, there's not a lot of exuberance in the bond markets for municipal bonds these days. They're not the most attractive investment, given the hemorrhaging that state and local governments are experiencing. We answer this problem by having the Department of Energy simply guarantee those bonds. So they're not going to default. You'll have a much lower interest rate. They become much more attractive for investment. I have inserted language into the House bill on climate change. It passed the House. It's unfortunately stalled in the Senate, but my language essentially authorizes the Department of Energy to use its existing loan guarantee authority and apply a portion of those $45 billion in loan guarantees to guarantee PACE bonding. Because the climate change bill is stalled, I've introduced a standalone bill, H.R. 3836, that we're trying to move forward. As I said before, both chambers of the New York State Legislature passed PACE enabling legislation in Albany. 15 other states have done that. We're trying to design a New York State pilot project to offer those lower interest rates and reduce upfront costs. Depending on, if you're in a state that has that authority, you should be working with the Alliance to Save Energy and my office on your applications to the Department of Energy. As I said before, those applications are going to be accepted in December, and the initial tranche of funding will go out in January. So we want to help you create those model demonstration programs under PACE jurisdiction and secure that funding. That was a brisk thumbnail sketch of PACE bonds, and I'd be happy to take any questions that you may have in the next several minutes.
Congressman, thank you very much. This is Brad at the Alliance, and we do have one question. First, let me mention that Carol and I are working on getting you a Senate sponsor companion bill for your bill, and we're going to have a meeting on Monday. Looks very good that in a very short time we'll have a Senate bill freestanding such as your own.
Terrific.
A question from Baker Davenport. He has a question relating to the property tax, and this is something that we've heard here at the Alliance as a potential issue in that it relates to the priority of the property tax assessment in relation to the purchase money mortgage. And Baker's question is, in most states, would the assessment be ahead of or behind a purchase money mortgage? And I guess related to that, does that raise an issue of concern on the part of the mortgage lenders?
Yes. In fact, I met with Assistant Secretary of Energy Kathy Zoy last week, and that is a concern that many in the investment community and financial services community, lots of banks are raising. We're trying to work our way through that. And Trish Russell is my senior legislative aide who handles energy issues and PACE, and she's on the phone now. She can give you an update on where we are with those conversations.
Exactly, and actually, the funding that the Department of Energy has a solicitation out for right now includes a policy framework for PACE, which provides for the federal funding to be used. Municipalities can create reserve funds. So in the event, to quell some of the concerns in the lending community, if there are late payments, that reserve fund can be used for that purpose. And there are other policy suggestions which I'd be happy to share with Baker if you'd like to follow up with me at any time.
The issue of subordination is I will be honest with you, is hanging up some of the progress that we'd like to be able to make on PACE. One of the reasons that I'm so thrilled with the $450 million in federal demonstration funding is because that will enable model programs to be deployed, and those model programs can find best practices to deal with that issue.
Okay, Congressman, the next question from Randy Bates, is the PACE bond program available in Colorado?
It is. Colorado is one of the 15 states that has passed authorizing legislation.
Right.
In fact, Jared, you should be talking to Jared Polis. Jared is a member with me on the Sustainable Energy and Environmental Caucus. I co-chair that caucus. Jared is a very active member, and Jared can help you apply for some of the $450 million in funding because he has been actually active in pushing PACE authorization in Colorado.
Excellent, Congressman. And after, when you need to go and vote, we'll list the states, the 15 states,
great.
including New York.
Great.
I guess the question next is the program through the block grant program, the $450 million you referred to, that's the retrofit ramp-up.
Correct.
And the
recovery through retrofit.
Recovery through retrofit that the Vice President announced several weeks ago. The question is this distinguished from the block grant program, or is this part of it?
It is a competitive portion. The other, hold on one second, Tricia. Forgive me, I'm just taking a look at the clock, and I've got 4 minutes, 27 seconds.
There was $3.2 billion in cumulative funding for the Energy Efficiency and Conservation Block Grant Program. $2.7 billion of it was.
Hey, Trish, I'm sorry, I've got to interrupt. Let me apologize. I've got now less than 4 minutes to do a 6-minute run to the Capitol, so I'm going to shake off. But Trish is available to answer any additional questions that you have. Thanks for giving me the opportunity, and Trish will take it from here.
Congressman, thank you very, very much.
Okay, so there's 2.7 that was distributed by formula, and the remaining, it's a little over $450 million. That is going out in a competitive solicitation. That is what the Vice President announced in October. And so that is the portion of the funding that the Congressman was referring to in his presentation.
Okay. Tricia, thank you for that.
Of course, no problem.
So the Congressman has left to vote, and we're next going to turn to Matthew Brown. There are some other questions that have come in, but we're going to cover those in Matthew's presentation. Let me just read the list of there are 15 states, of which New York just acted this week, that have PACE-enabling legislation. California, of course, is the first, as Julia mentioned. I think the first PACE bond program was originated in Berkeley, California. I think the first one may have actually been issued in February of this year in Berkeley. Colorado, Illinois, Louisiana, Maryland, Nevada, New Mexico, Ohio, Oklahoma, Oregon, Texas, Vermont, Virginia, and Wisconsin, and, of course, New York. Next, I have the privilege of introducing Matthew Brown, who is going to give the bulk of our presentation here in the webinar this afternoon. He is a principal of the firm of Conover Brown, who has concentrated on energy policy and finance issues since graduating from Brown University in 1986. He has worked with the states of Colorado, Iowa, and Michigan to design improved energy efficiency financing tools, and he is part of the Department of Energy's informal financial SWAT team. Maybe Matthew will tell us a bit about that. I didn't know that DOE had a financial SWAT team. He provides technical assistance for revolving funds and other expertise on financing to the Department of Energy. So with that, Matthew is joining us from Colorado. Thank you for making time for this webinar.
It's great to be here. Thank you, Brad, very much. To add to your list of states that are that have now passed legislation on PACE, I know that there are several others that are considering it. I was on the phone with people from Iowa earlier today, and there's legislation that will be introduced this coming year in Iowa at the very least, and I know in a number of other states as well. So it's a very interesting new kind of a mechanism for addressing energy efficiency. So what I'm going to do is I'm going to spend about the next 20 minutes talking about energy efficiency financing from a kind of a broader scope of what it is that what some of the objectives are of energy efficiency financing programs, and then the mechanisms for the financing mechanisms that are being set up in a number of different states and local governments. And as I do this, I sometimes refer to kind of the three S's of financing, which are security, simplicity, and scale. And really, when we are looking at energy efficiency financing, those are three of the most important things that I think we're really focusing on. And these are, in some cases, each one of these three S's has been missing from previous efforts to develop financing programs. So from a security standpoint, what we're looking at is what are the ways that we can use to improve the security of the financing mechanism, to improve the security of the loans that are being offered, and so that they are stronger, better quality loans. From a simplicity standpoint, if you look at the history of energy efficiency lending and financing over the past 20 to 30 years, it is replete with programs that have been that have put money out there and have been actually closed on 6, 7, 8, 9, 10, maybe 50 loans. There are just the offering of the financing is one thing. Getting it simple enough so that it actually does not stand in the way of people completing energy efficiency retrofits is an entirely different thing, and that has to do with simplicity. And finally, scale. Scale is tremendously important. We are talking about not doing 6 or 10 or 50 loans. We are talking about not doing hundreds or even thousands, but hopefully hundreds of thousands of loans. And this is where financing becomes so critically important. We're moving beyond a point where we can really look at just grants and rebates being able to do this. We're moving to a point where we need to be thinking hard about moving to much larger scale, and this is where we need to have financing. There's a slide up here that talks about this and some of the basic needs, or the basic needs that financing programs meet, particularly addressing a first cost barrier, credit management, bringing in low-cost capital to the programs. So as broad context for this, and this goes to the simplicity question, I always like to bring this up. For most of the world, if it's a small, in terms of the volume of potential borrowers out there, whether it's small commercial or whether it's residential customers, most of them, for the most part, really don't think an awful lot about their energy bill. There are a few very large energy bill payers, aluminum smelters, large industrial manufacturers who care a great deal. But for the most part, we have to be pretty aware of the fact that many people really don't care all that much about their energy bill. They will care some, and this again goes to the issue of simplicity. So what you're going to hear me, this is probably be the last slide on the word simplicity here, but I think that one of the points here is, as you look at different programs around the country, there are the successful programs that have been in operation have been those that have allowed for easy access to financing. Typically, what we're talking about are loans that are in the residential sector, $5,000 to $7,000. These are not large loans. They require a very different level of underwriting, very different level of due diligence from a $150,000 or $500,000 mortgage loan. The competition for many of these energy efficiency loans is not loan products that mortgage banks offer. The competition is really a Lowe's or a Home Depot credit card, or a consumer finance product offered by GE Money through a furnace or insulation installer. So first of all, I think it's important to keep in mind that the simplicity has to be designed and the design of these programs has to be really set up pretty carefully for the size and the relatively small size of these loans. The other thing that's important to keep in mind when looking at this is what the alternative sources of credit are. I'm not going to spend a lot of time on this, but from a residential perspective, home equity lines of credit, which are typically variable rate products, These do assume that one has equity in the home, which is not as common as may have been the case even 2 years ago. These are more difficult to access than they were a couple of years ago. That's one source of credit and source of capital that consumers have been able to use. Consumer credit, as I have just noted. In addition, on the commercial side, the small commercial side, small business administration loans and guarantees are another source of capital on the small business side. Very different kinds of products on the small business side from typically what is being offered. So what I'm going to do is I'm going to talk briefly about, or just kind of a reminder of what it is we're financing, and then talk in much more detail about how we are financing these things. Typically, and the markets that I'm focusing here on are homes, residential sector, and small businesses. Typically what we're talking about are home renovations that might be based on an audit. They might be a larger scale kind of project that would include insulation, duct sealing, heating, ventilation, air conditioning. It would be unusual to have a project that in many cases would exceed $10,000 or so in most cases, although you certainly do have larger houses where the figures go substantially above that. Typically, though, the projects that you're looking at are under $10,000. On the small business side, it's usually $8,000 to $12,000, a lot of a lot of lighting retrofits, some HVAC as well. In terms of how these programs are marketed, typically, these are marketed through contractors, whether they're electrical, HVAC contractors, in some cases home performance, auditors, which are going after the whole house approach. In general, when you look at what's the programs that have worked around the country, these programs are not marketed by lenders, although there certainly are some. And I guess energy-efficient mortgages, which we won't talk a lot about, are marketed primarily by lenders. Government agencies, utilities, in general, and with some exceptions, have not been the primary ones to market these. It's really been the contractors. Contractors are key, and in particular for the unsecured loans, and these are the loans that are these $5,000 to $7,000 loans. Typically what happens is contractors receive education on the financing program, so they're taught what the financing program is. They're taught about how to essentially upsell energy efficiency. So think about in one kind of application, it's January 15th, the consumer's furnace has gone down, they need a new furnace. They call a contractor. They don't typically call the utility or the energy office. They call a contractor. The contractor comes in and says, yes, you may have an 80 AFUE furnace, relatively inefficient furnace, but I've got a special deal for you through this program for a 95, much more efficient 95 AFUE furnace. Here's the one-page application which you can fill out, or here's a 1-800 number that we can call right now, or there's a web application. Customers and the contractor know very quickly about pre-approval, and the program moves very quickly. So the financing is not a barrier to the total here. I've already touched on these couple of things. I want to spend some time in particular on the how. How are these financing programs structured? And there are two kinds of models which are very similar. I've put together a flow chart and it begins to put all of these different pieces together. So step one, typically a customer is going to contact a contractor to arrange for work. The customer is going to fill out a loan application that the contractor will provide. And that is then using the 800 number or using the website that is then approved or disapproved by a lender. So the lender is the one who is actually doing the loan origination. One of the structures that's becoming, that a lot of states are looking at, and some of the states that I'm working with in particular, is that the financial institution, at the time that they approve the loan, a third party, which could be a state, it could be some other entity, is going to escrow a loan loss reserve, typically set at a low of 5% and up to, on the very high end, maybe 3 times that level, typically 5 to 10% for a loan loss reserve. Is escrowed, set aside to cover any potential losses. Contractor completes the work, the lender pays the contractor upon approval by by utility, if the utility is involved in the program, and by the customer. And then there are two things that can happen. One is that in an on-bill kind of system, the utility places a principal and interest charge on the utility bill, and the utility pays the lender upon receipt of payment from the customer. Or a lender, if in a third-party mechanism, a lender could bill the borrower through a third-party servicing agreement, through a third-party bill, and the customer would then pay that lender. In the case of a default, that loan loss reserve, or it could be set up in a number of different ways, but in case of default, that loss reserve is available to the lender. Another kind of model, slightly different, and is that you have an investor. So in this case, you don't have the lender is not the one who is holding on to the loan over the course of the full period of the loan. So if it's a 4 to 7 year loan, the lender is actually selling off that loan to an investor. It could be to a Fannie Mae in some limited cases. It could be to another investor, and we are in talks with a number of investors about providing what we hope would be a significant amount of capital through this kind of structure. So what happens then? The lender makes the loan. There's still some kind of credit enhancement or loss reserve set aside, and there's a loan servicer that bills the customer, and the customer pays this loan servicer. It might be the lender, but keep in mind the loan is held by an investor, and that investor then has access to that loan, or excuse me, has access to that credit enhancement or loss reserve. So typical loan terms, usually in the 2 to 10 years for most of these kinds of loans. The kinds of loans that you just heard from Congressman Israel are secured by a property, a lien on property. Those are typically in the 20-year range. Typically, though, for the vast majority of programs that have been out there at this point, small business loans tend to be in the 2 to 4 year range, essentially taking into account the fact that small businesses may be likely to move or may not have as long a life. Residential loans tend to be in the 48 to 60 month range. There is a model through which the loan is actually, it's not so much a loan, it is a tariff charge. So if I move and Brad Penny moves into, if I move into a house and I install insulation, HVAC, and other energy efficiency retrofits, Brad Penny moves into my house. And these have the financing agreement is a 10-year financing agreement. He takes over those payments, so it's essentially extending the life of that amortization period. Turns out that can be a very important kind of mechanism to keep loans and to keep energy efficiency affordable. Now I throw this up here: influence of loan term on payments, this shows that if you move from a 16-month to a 36-month term, and this is kind of a hypothetical, but if you essentially double the term of a loan that has it's an $8,000 loan, if at a 16-month term, this is based on a 0% loan payment, which is a structure that exists in Connecticut at the moment. Based on a 0% loan payment and energy savings that are set aside that would be estimated in Connecticut for a small commercial customer, by doubling slightly more than doubling the length of the loan, you are going from a $25 monthly savings to $332 monthly savings, incorporating the energy savings and the financing charges. So the power of long-term amortization is absolutely critical for all of this. Just to give you a couple of examples, Pennsylvania has a loan term of up to 10 years. Typically, those programs will be in the 48-month range. Boulder, Colorado, with the PACE program, is a 20-year program. Connecticut has a program where typically the loans are 2 years long. Another issue is security and collateral. So very typically, these loans the loans that are most common in the residential sector and the small commercial sector are unsecured loans. You get secured loans when you get into larger scale investments, $15,000, $20,000 kinds of investments that may typically include solar and somewhat more expensive larger scale retrofits where there's more money at risk. Very often, though, we're talking about unsecured kinds of loans. And again, the market for these kinds of loans is kind of a quick decision type of market requiring very fast credit analysis. Interest rates, typically, there are programs that are 0% interest rates. I think potentially outside of the small commercial market, I don't think that 0% interest rates are by any means necessary. Interest rates, if in the 7 to 8% range in the in the residential sector, are quite appropriate. When you look at the most common in the programs that have been most successful, those programs have had interest rates ranging from 5 to 9%. Manitoba Hydro, which is obviously not in the U.S., in Manitoba, has $200 million worth of loans outstanding in there for energy efficiency, and their loans have been in the 5 to 6% range. Pennsylvania has more than 3,000 loans outstanding worth $20 million. Their loan interest rates have been typically in the 7 to 9% range. There is no need to have a 0% interest or even a 2% interest rate kind of loan here. Loan servicing, we talked about this a little bit. Pennsylvania is an example of a state where a third party, a lender, services these loans. There's a model that's based in using a Fannie Mae using Fannie Mae as an investor, where Fannie Mae essentially has a loan servicer. So one example of this entity is Energy Finance Solutions, based in Wisconsin, serves as a loan servicer, serves as a loan originator. Immediately on a daily basis can sell these loans to Fannie Mae, who has these loans serviced. Finally, utility service loans. You hear a good deal about on-bill financing programs these days, and I think it's a model that's very worth looking at. It's something that it's a model that exists in several different states at the moment, and something that I'm not going to spend a lot of time on, but we could spend a considerable amount of time talking about the on-bill financing in particular. There is a paper, or actually two papers, which you can download talking about various issues there. Origination and underwriting. Typically, it's those with the capital at risk provide the underwriting. Usually you're in a utility model. Utilities tend to look only at bill payment history, very often do not look at credit scores. Lenders always will look at credit scores. 640 kind of FICO score is typical, often something a little bit higher than that. When we're talking about financing, we are not talking about reaching the lowest income people. We are really looking at people who tend, at the moment at least, tend to have higher than average credit scores, something to be aware of. Credit and default rates for these programs. This is not something that's really these loans don't tend to be high-risk loans from an investor and lender perspective. This slide gives a sense of that. In part, that's a result of those credit scores and the underwriting criteria that's been used. But typically, for a consumer credit, you would be seeing 5–6% kinds of losses. But in this kind of consumer credit, maybe because people are not using it to buy the flat-screen TV, you get more of the, I'll call it kind of the thinker kind of, as opposed to a reactive buyer. But you often get people who are more kind of thinking longer term. You get relatively low default rates on these loans, less than 1% in many cases. As a result, many states have put together credit enhancements, and there are several that are looking at doing so with using stimulus monies. But it's not always done with stimulus money. I'm working right now with the state of Michigan to help them structure a credit enhancement program. I've worked with the state of Colorado, essentially structuring a credit enhancement program where they will, in Pennsylvania, there's a 5% loss reserve set aside. So in other words, $1 million set aside for a $20 million portfolio of loans that enables the lender to make these loans with a sense that knowing what the losses tend to be, knowing that they are in a relatively secure position. Illinois has maybe done more than it might need to do in some ways. It has set up a 100% loss provision for an on-bill financing program. And as Congressman Israel mentioned earlier, the Department of Energy is examining loan guarantees as potential. I have included on the rest of this presentation, which is downloadable, a number of slides that go into more detail on some of these programs that you see. I'd be more than happy to entertain some questions and discussion. I think just to kind of wrap up here, we're really, again, I guess I look at this as kind of a second generation of financing for energy efficiency that engages the private sector. I've talked about state programs. I'm also working with a number of private sector organizations to set up financing programs as well. But really, it comes down to the three S's that I talked about: the security, the simplicity, and the scale. Very, very important in this new generation of programs. So, thank you very much.
Matthew, thank you very much, and let me urge our audience to send their questions in. As we're waiting for the questions, I do have a couple for you, Matthew. One question we're frequently asked here at the Alliance is about how the initial audit is paid for. You know, the homeowner who's looking at doing a retrofit. In the kind of financing programs that you've described, is that typically rolled into the financing package, or is that an upfront cost?
This really varies, but typically there's a couple of structures you see out there. One is that it may be a subsidized audit, and if the customer elects to pursue the measures that are identified in the audit, then the customer gets access to the subsidy. If they don't, then they end up paying for the full audit. And in most cases, customers would be allowed to roll the cost of that audit up into their into the financing agreement. Typically, I think you're looking, $350 to $400. Although I've seen charges. It's interesting, as these programs have been rolled out, that require audits. In some cases, I'm seeing $750 for the cost of an audit, which is quite high. But I think one of the things that's happening, I think, is there's not a lot of auditors out there. And as we're seeing more and more of these financing programs start to roll out that require audits, I'm seeing the cost of the audits increasing, so it's becoming an issue.
Matthew, let me ask you a question in terms of your reference to the lack of auditors. One thing we're hearing is that in the next round of a jobs bill, which may come very early in the new year, there may be a lot of money invested into building retrofits because of the administration's belief that could be a major source of new job creation. In your opinion, having worked this field the number of years that you have, is the infrastructure out there going to be able to absorb, a blizzard of funding, as we might refer to it? How will this world of energy efficiency financing, as you've been describing it, be affected by like a massive infusion of money as a jobs creation measure?
Well, it certainly could be a good jobs creation measure. I guess if I take your question right, it's one of the answers to it is do we have the auditors out there?
Right. Do we have the personnel?
Yeah. The answer is that in many cases, the answer is that it varies, and in some states there will be that have had a longer history of energy efficiency. A relatively small number of states that have a longer history of energy efficiency programs and doing audits. There's a much better infrastructure set up than in some states that really have very, very few of these auditors. The other point is even in states where there may be auditors out there, they may be in one part of the state. They might be in the urban part of the state, but they might not be in the rural areas. So it's a pretty significant issue, I think.
Okay, thank you, Matthew. We do have a question, and it is, how do the PACE bonds, as described by Congressman Israel, compare to the on-bill financing, which you alluded to, didn't say too much about it? And maybe could you tell us how your excellent paper, which I have on on-bill financing, helping small business reduce emissions and energy use, while improving profitability. Where can they go to download that?
That paper is, I believe that the paper may be available now through your website, right there, or through your through the webinar. I think I sent it just a few minutes before, so I don't know if you had a chance to put it. Carol had a chance to get it up there.
It is now on the Alliance website.
Okay. However, it was a paper that was done for the National Small Business Association, and so it's also available through their site as well. And actually, it's available through my own website, conoverbrown.com. So the question, though, is really kind of comparing PACE models and on-bill financing models. And so PACE, the way that I see it is, it involves it's a somewhat more complex kind of process than the typical on-bill financing program. On-bill financing is, to my mind, ideal for a situation where simplicity is absolutely key. So a small commercial program, for instance, where the borrower is a restaurant owner first and foremost. The borrower is a dry cleaner first and foremost. And having an auditor come in and identify measures and say, here's the plan, if there are utility rebates available, here are the rebates, and by the way, there's no upfront cost to you because here's the financing, and all you have to do is just sign on the bottom line here, and you are given, we will come in as the contractor on contract to the utility to install these measures, and they show up, the financing costs show up on the utility bill. Typically, these are set up, the programs that are in existence now are typically set up such that the energy cost, the energy cost savings actually exceed the cost to finance the principal and interest charges, to cost to finance the project net of any rebates that are offered. So these programs, the on-bill financing is a very it's ideal in that it's simple from the consumer's perspective. It's simple from the contractor's perspective. PACE, the way that I see it, is ideally suited for perhaps somewhat larger projects where you might put a lien on, where you would put a lien on a home. You definitely involve an audit in this kind of approach. Typically, the PACE programs that have been in existence so far have been really focused on larger energy efficiency retrofits and solar energy. So the Berkeley program is highly focused on solar, and other programs have done solar and energy efficiency typically. So the way that I kind of view them is that PACE is often more appropriate because there's a little bit more complexity involved in it. Because there's a lien, it's a little bit more appropriate for a larger kind of project. Maybe just move back to on-bill finance for just a second. On-bill finance is ideal from a contractor's perspective in many ways. Consumers tend to like it. From a utility perspective, many utilities do not have billing systems that are set up to handle this kind of on-bill financing. Some do, some don't. Some utilities are also concerned that this puts them into the role of being a lender, which is not really a comfortable role for many utilities. From the perspective of a lender who might be providing capital, there are some lenders who are concerned that essentially you have the lender providing capital, but the utility that's collecting and servicing that bill. So there's no, you have a different party that's collecting the money from the party that's providing the money, and it seems to be one way that it puts the utility, puts the lender at more risk than in some cases lenders are comfortable being in.
Matt, you mentioned the secondary market for the type of financing mechanisms. How has that secondary market been affected by the recession? Is it a very robust market, or up to this point has it been relatively small?
Well, it has been relatively small. 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 the secondary market for this kind of loan is a market in development. So, and it's been very thin to this point. So, at this point, that secondary market consists for this kind of loan largely of a Fannie Mae product, where Fannie Mae, through its energy loan program, will buy these smaller loans from one of three qualified lenders. And so, at the moment, at one point there were, I believe, 11 qualified lenders. At the moment, there's AFC First, Energy Finance Solutions, and ViewTech, which is based out in California, which can offer these loans and then sell them to Fannie Mae. So it's a pretty thin market. I don't think it really has not been affected by the economic conditions at this point. We are looking, and I say we, I'm working with a group of other people from a number of different organizations. We're looking at developing a much more robust, much larger market, which goes beyond Fannie Mae, and would require, though, the development of a standardized and kind of conforming loan product that would be acceptable to this broader market. To this point, most of the loan products that have been out there have been fairly kind of I guess the word might be patchwork quilt. You've got a utility with one kind of product here, and a state with one kind of product there, and a lender with another kind of product out. And it's very hard to create a market, an investor market that's interested in buying loans that look so different. It's very hard for an investor to analyze those loans.
No, that's a very important point. I think at this point in the webinar, Matthew, we are going to give our audience the opportunity to engage directly with you. And I'd like to ask anyone who is on the webinar this afternoon, if you would like to pose a question or comment or have a discussion with Matthew on a particular point, to hit *6 on your phone, and you should be unmuted. And we invite you to do that, and we'll be happy to take your questions. Okay, anyone?
I have a question. Matthew, essentially going back, you said that the consumer financing was mostly around 45 to 60 months. So it's almost just like a car loan, correct?
In many respects, yeah, you could think of it that way. It's a little different in that typically they're unsecured. So it's very hard to go back and scoop the insulation out of the house. So there's no car behind it to actually as security. But
right. Okay. So what is like? Did y'all do? What was like the median income for people that were taking advantage of the financing? The reason why I asked that is the reason why I compared it to car financing is the car sales being down. I'm wondering what the median income is of people that are taking advantage of refinancing.
I don't have an exact figure for you, but I do know that in general the median income of the people who've been taking the financing has been above the average. And I kind of mentioned this before. This is when we're talking about loans for energy efficiency and the people who've been interested in taking out these loans. These are not typically these are not low-income programs, and this is really this is for the programs that have existed thus far have really been much more focused on the above-average income people.
Are there ways to get it to penetrate into the middle-income areas? Are there ways to? I'm sorry.
Yeah, I think so, and I think a lot of it does come down to marketing, and I think that the trick is keeping. There's not always a correlation between income and willingness to pay. In other words, an income and credit score, and so I think there's a lot of potential to do a lot of this in the middle income areas. I mean, when you think about it, for higher income people, for a $5,000 to $7,000 investment, they will probably be able to just write a check. It really is. These programs are most valuable, in that kind of middle income and up areas. But I think it really does come down to the marketing.
Hey, Matthew, this is Randy Bates. I just got a question about what small business owners could do in order to help implement these programs in their communities. I mean, I understand, I live in Colorado, I live in a suburb of Denver, and I understand Boulder has a program. I am curious as to whether or not there are any best practices or any feedback on what an individual can do to try to help implement these programs in their communities. And then secondarily, does the upgrade impact the appraisal value of the home such that if the homeowner does sell it and the secondary owner then assumes that debt, is there a buy-in to assume that debt for the secondary homeowner either through the value of the home or, you know, are there any experiences with that and how that works?
I'll take the second question first, and the answer is probably. But it has an order. The answer, I think, maybe I'll be a little bit more positive on it. The answer is yes, there is an impact on the sales price, but no, it hasn't been proven out so much so that it is something that many financial institutions will really take recognition of. And this really gets to the issue of appraisals. And when you're doing this in the small commercial side, in the large commercial office buildings, or it may be slightly different, but certainly on the residential side, when you're getting a home appraised, and maybe it's an Energy Star or a better home, a compliant home, typically the appraisal will not take that into consideration, even though there have been a few studies. There was one study that was done recently by a group called Earth Advantage, which is based out in Portland, Oregon, that has actually looked at this issue. There's the value of homes. So it's kind of it's an issue that needs some attention. It basically needs data so that people can take advantage. As far as the Brandy, the question, as far as what an individual business owner can do, were you thinking on the financing side of it in particular?
Well, the way that I understand this is that there's either the option to do the PACE bonds, which are supported through local municipalities, correct? I mean, that would be something that a local municipality would have to implement within their community. Is that correct, my understanding of that?
That is correct. Mm-hmm.
So how does, I mean, I know it seems pretty obvious, but would I just talk to my local city council person and try to figure out how to make this a program available in my community? How do you start a program in a community or a municipality?
Okay. Well, so in the case of Colorado in the last election, was it Gunnison, Pitkin, and one other county combined, and they passed legislation to allow for PACE-style bonds, and that's really, that was the first step to, in the case of Boulder, that they passed legislation to allow for the issuance of the bonds.
Okay.
So that's for the PACE style. So it would essentially have the same thing would have to happen.
Okay. And then as far as the secondary market loans, I mean, are those things available now, or are there just pilot test programs that are out there now? I guess I'm trying to figure out how I, who am not in a market where the programs exist, can try to either help implement the programs, whether it be PACE or secondary market, so that everyone can try to take advantage of these programs.
Give you some specific examples, and these I know there's people from all over the country on the webinar, but and so there will be programs that are going to vary from one state to another. I happen to know that in Colorado there are a couple of loan programs which are going to be rolled out within the next year that are going to be available through lenders and sponsored by the Governor's Energy Office that will allow one of them at least will allow for this kind of thing. So it's there. In many cases, you're going to see, in Colorado specifically, you will see some of these programs available.
Okay, so this is something that's probably just going to happen above our level if it's on a secondary market program, but if it's a PACE program, it might be something that if we're interested in trying to start these in our communities, but just kind of start from a grassroots movement.
you would start from the grassroots movement within your communities.
Okay.
The other programs will be offered. It's one of the things that many states are now looking at doing, including Colorado.
Okay, thank you.
And once again, a reminder to our audience, you can either do the chat room function for sending us your questions, or you can do *6 on your phone, hit *6, and you'll be able to ask a question directly or have a conversation with Matthew Brown. We do have a question concerning how the presentations can be accessed, and if I could invite the audience to look at your toolbar at the top of the screen, you will see an icon, and if you click on the icon, it will come up as handouts by clicking on the icon. And if you go there, you will be able to download the presentations of Matthew and Congressman Israel, and also the other publications that we've referenced during the program. So again, go to your toolbar, scroll over, and look for the icon, click on it, and it will say handouts. Matthew, wondered if you could say a few words about energy-efficient mortgages. We haven't touched on that so far. Of course, that's a subject that there's always a lot of interest in, and I think a lot of frustration that more progress has not been made. What will be your comments on energy-efficient mortgages?
Energy-efficient mortgages have a long and not terribly successful history. They've been available in some form or another really since 1979, 1980, and I think came out to great fanfare and hopes. The idea here, sometimes when I'm looking at this kind of thing, I think of the energy efficiency financing world in terms of transaction points. So at what transaction are you attempting to influence somebody to do the energy efficient thing, whether it's the January 15th and your furnace is broken, you need to get a new furnace, or whether it's an energy efficiency retrofit because you want to do it to make your home more comfortable. So the energy efficient mortgage was designed to take advantage of the transaction point at which people are buying the house and originating a mortgage. It's potentially a powerful kind of tool because of the amortization period, that long amortization period, over which you can spread the costs of an energy efficiency retrofit. It's secure, so it has kind of one of those second S's that is dealing with security. One of the three S's, dealing with security. It's because there's the home that's securing that. But it failed miserably on the simplicity front. The energy-efficient mortgages in general, from the perspective of a lender, there really wasn't a lot of benefit for the lender to pursue these. In fact, many lenders simply viewed them as something where they were just required to do an audit, to escrow funds, to do a lot of additional paperwork. But their fee structure did not really encourage them to really do these. From the realtor perspective, because of the audit, very often these ended up taking more time than a traditional mortgage, and so really many realtors have discouraged them. And even from a customer perspective, there hasn't been has not been a lot of interest because they've been allowed to include the cost of the cost of energy efficiency measures in their mortgage, but there hasn't been a huge financial benefit for many of the customers. That said, there's a couple of models that are out there that have some promise, and in Maine, in New York, and actually in Colorado, there's a couple of these. I'll describe one energy-efficient mortgage product in Colorado. Actually, it's available through the Bank of Colorado, where they have partnered with the state of Colorado to offer what they're calling it's an Energy Star mortgage and an energy savings mortgage, essentially the same kind of thing. But built into that, the state has provided half of the cost of a buy down, and the bank has provided the other half of the cost of a buy down that could provide an interest rate discount ultimately of the mortgage. And over the course of over the length of the mortgage, that's a very significant reduction. So in addition to getting the energy savings, you're getting an interest rate discount. This is something. It's a very new product, and I know in the case of the Bank of Colorado program, it is starting to really take off. Because it's available both for the retrofit market as well as for new homes.
Well, that's very significant. In other words, you could do this on a equity mortgage type application as well.
Yep.
That's very good. It would seem as if the key to the incentive is to get to the point where you can get that break on the 1/4 to 1/2 point reduction on the interest rate, as opposed to simply qualifying for a higher mortgage.
There's a real incentive there. One other point there is that the mortgage, Fannie Mae had a specific mortgage product called the energy efficient mortgage, which had all of these requirements. This particular mortgage product is not that. This particular mortgage product is a regular purchase mortgage, and so that the lender just sells it into the market, much as they would with any other mortgage. They don't have to do anything else besides offer this discount. It's a much simpler from the lender's perspective, much simpler, and it offers something that's of a lot of interest to the consumer.
Yeah, that Bank of Colorado product, that's of great interest. That's something we want to watch. We're down to the final 10 minutes of the webinar, so I'd like to invite our audience to either use the chat room for questions, or if anyone right now would like to hit *6 on their phone, hit *6. Does anyone have any questions or comments?
When Congressman Israel was speaking earlier, he referred to Jared Polis. Do you guys have contact information for him?
Matthew, is that name familiar to you?
Jared Polis, the congressman?
The congressman, he made a reference. I don't know if Tricia Russell is still with us. We can get that from her.
But Jared Polis is the congressman.
Yeah. Oh, you're talking about? Okay.
I have a question regarding the PACE financings, if I could ask that.
Mm-hmm.
Please.
Congressman Israel talked about PACE financing largely being done by individual municipalities accessing the capital markets. And one thought is that may be a somewhat inefficient way to go about that it may be more efficient for states to aggregate multiple municipalities and to go to market on kind of a pooled or aggregate basis. Are you finding that other states are using that kind of approach to access capital markets in a more efficient way?
Nobody has done that yet, but you're right. One of the issues that's when you get multiple municipalities, especially smaller municipalities, doing this, and there are certain fixed costs to an issuance like that.
Mm-hmm.
So if you can reduce that fixed cost, it's much more cost effective. So that's nobody has done it yet, but there are several states that are looking at that.
Brad, this is Baker Davenport.
Yes, Baker. How are you?
I'm doing pretty good. Long time no see.
Yes, indeed.
I have a question regarding the PACE, and I'm curious. Am I to understand that an issuing authority, such as an industrial development authority, can issue these PACE bonds for a project?
Yes.
And are they taxable or tax-exempt bonds?
I don't know if they're taxable or not, but they can be issued by a municipal finance agency. Do you know, Clay, on that point?
I can provide an answer to that. And
Please,
the answer is yes. They can be either one. So a specific example, Boulder County used tax-exempt private activity bonds for part of its issuance and non-tax-exempt bonds. Tax-exempt bonds often will have more strings attached to them. So in the case of private activity bonds, there were income eligibility restrictions. that meant that the recipients for received funding that had come from the private activity bonds had to be income qualified, and the others did not have to have any income qualification.
Well, I have a reason for asking, because I have a $3 million project in New York City that I'm not going to reveal the name of over the phone here, but we pretty much hit the wall for financing energy efficient project that was supposed to go under the Clinton Initiative protocol that could possibly fit for this. And I'm just trying to figure out how it works.
My guess is that I'd be happy to talk to try to understand a little bit more about that. It may be a bit more. It may be kind of project specific. I will say, if this is for an individual project, the PACE programs typically have been designed on the basis of programs that are property tax tied to the property tax for residential.
I don't think there's a single building in New York City that doesn't pay a tremendous amount of property tax.
Understood, but I think typically they have been focused on the residential sector. So I'm not sure. I'm not knowing at all what you're looking to finance.
It's a multi-tenant building.
Multi-family building. Okay. Yeah, I don't know. I mean, that would be worth pursuing. Without knowing more detail, I couldn't really provide a lot.
It sounds, Baker, it might be worth contacting NYSERDA, which is the New York State Energy Office. I'll call you offline and provide you with a contact there.
Well, NYSERDA wouldn't issue the bonds. It would
No, but they might be able to.
Or somebody else.
Right. They could just give you some advice as to best how to proceed, you know, given their familiarity with financing in New York. I'll give you a call.
I want to talk to you anyhow, so.
Great. Okay, we're down to the last couple of minutes here. Do we have any other, anyone else have any questions or comments?
Hey, Matthew?
Yeah.
Yes,
on the
this is
PACE funds, you
Ann
may not.
Kelly. I have a question. I'm in Pennsylvania. What opportunities are there for school districts to get some kind of financing for energy efficiency retrofits?
It sounded like we had two questions coming at the same time, but the question was on school retrofits and moving beyond the energy service company kind of model, which and ESCO markets, which typically have been very active. And I assume that that's kind of the assumption of your question is kind of what beyond the typical energy service company financing is available. Or I could, I mean, typically the energy service companies, which will finance, they will come in, they'll do a turnkey approach to an energy efficiency installation, and at zero upfront cost to the school district or the hospital or the local government for which they're doing the retrofit. They will finance that improvement based on the promise of energy savings, and they will then use that energy savings or a portion of that guaranteed energy savings to finance the energy efficiency retrofit. In addition, though, there are a number of states that are looking at using stimulus funds to further reduce the cost of energy efficiency retrofits in the school sector. So that's another kind of an area that where they might be combining with energy service companies to reduce the cost of capital or buying down the cost of capital. They might be offering a supplemental loan kind of thing. Those programs have not been rolled out as of yet.
There may also be some bonds similar to the CREBs that can bring the interest rate, like qualified energy conservation bonds and some others that may be available to schools.
Yeah, qualified energy conservation bonds and other. There's another category of bond called a QZAB, or other kind of very low interest rate bonds that provide a lower, a cheap source of capital. Again, typically on the order of, they're supposed to be 0%, but typically on the order of about 2% is the cost of capital. So I know a number of states are looking at using those QECBs for that as well.
Okay, thank you, Ann. Good question. And now we have a question from Clay Crownover.
Hey, Matthew, on the, I may be misunderstanding. On the PACE bonds, and you may not be able to answer, they put a lien on the home, and I'm wondering for residential homes, when you sell your house, someone else buys your house, how do you transfer that lien, considering as far as buying title insurance to make sure there isn't a lien on your house?
You know, I am not sure on the documentation that gets transferred. There is one of, but you're touching on the a very critical issue, which is partly the issue of disclosure for the new buyer. But when it comes, honestly, I could research that. I don't know the answer when it comes to the specifics on the title insurance.
I mean, presumably, Matthew, I think that'd be an issue in the title search that has to be done before the closing on a loan.
It would be, and it's a matter of the proper disclosures.
Right.
And actually, these disclosures are an issue not only in the PACE type of program, but also in the tariff-based on-bill financing kind of programs, where there needs to be disclosure that there's this encumbrance.
Now, in the case of the on-bill, does the liability go with the real estate owner who's moving out, or with the property itself?
In the case of there's two models. In one on-bill model, there's a loan, which is either a personal or business loan. So when the occupant leaves, the occupant pays that off. The other is a tariff-based approach. So when the occupancy changes, the new bill payer, it's based on whoever pays the bill, the new bill payer takes on that obligation.
Okay, that's very helpful. Any closing questions or comments for Matthew? Okay, if not, we thank you, Matthew, very much. That was a great presentation, and thanks for your patience through all of the questions. Just before closing, I would like to remind our audience that the Alliance, for anyone who's going to Copenhagen for the Climate Summit next month, the Alliance is going to be doing a side event on Monday, December the 14th in Copenhagen. It's labeled From Paradox to Paradigm, the Role of Energy Efficiency in Creating Low-Carbon Economies. You'll see it on your screen. And Secretary Callahan will be participating in this, and I would like to invite you, if you are going to be in Copenhagen, to email our colleague here at the Alliance, Sandy Fard. Her email address appears on the slide, and she'll be able to give you all the details as to the location of the side event and how you can be brought into the event as a participant. So I'd like to thank our audience very much this afternoon. I'd like to express my appreciation to Julia Levin for taking the time to introduce Congressman Israel, and to Steve Israel, who, as we said at the outset, is a member of our Alliance board and just a huge champion of energy efficiency. It is such a pleasure to work with Steve and Tricia Russell and his office, and we look forward to continuing that in the future. And again, our great appreciation to Matthew Brown. I'd also like to express my thanks to my colleagues, Carol Guest, Paul Lusko, and Clay Crownover, who did a great deal of work to put this webinar together, make sure it lands. And I thank you very much, and enjoy the rest of your day. Good afternoon, ladies and gentlemen.
know that there's going